To avoid falling for cheap scam stocks or overpriced expensive jokes, watch this video. You know that sick, hollow feeling when the stock you knew was a winner collapses 60, 70, 90% and your account balance looks like a bad joke. The rent check bounces, vacation canceled, and your spouse won't even look at the brokerage app anymore. You lie awake replaying every thread, every CNBC soundbite, every "this time is different" story you swallowed whole. You feel scammed, stupid, and terrified it will happen again. You're not alone. Millions have lost years of savings chasing the wrong names. But here's the good news. That pain ends the moment you learn how to spot a truly cheap stock instead of another expensive mistake dressed up as opportunity. I've been there. In 2009, I was 23 years old, freshly laid off from Lehman's back office graveyard shift, carrying $47,000 in credit card debt, and living in my cousin's basement in Queens. My entire net worth was $4,200 spread across 3 stocks I had bought at the absolute peak in 2007 because some guy on CNBC screamed they were going to the moon. Washington Mutual, Circuit City, Fannie Mae. You can guess how that ended. I remember the exact moment I realized I had no idea what those companies were actually worth. I was just gambling on the greater fool showing up before I ran out of money. Guess what? That humiliation became the best teacher I ever had. This masterclass is not theory. It's scar tissue. The central question that decides whether you eat steak or ramen in retirement is brutally simple. How do you know, really know, when a stock is cheap or expensive? It's not always what the analyst on television says or what the Twitter crowd are memeing. Instead, it's all about you. By yourself. With numbers you can defend in front of a mirror at 3 a.m. when the market is closed and no one is there to lie to you. Let's begin. The only 2 things that matter. There are only 2 questions that determine whether any stock, at any price, in any market, is cheap or expensive. What is this company actually worth right now if someone handed you the keys today? And how does the current stock price compare to that number? Everything else, charts, macroeconomic forecasts, Fed statements, Bitcoin correlation, is noise until you can answer those 2 questions with cold, defensible math. Most people never do the math. They buy stories. AI is the future. This is the next Amazon. Elon tweeted a rocket emoji. Stories feel good until the margin call hits. In March 2020, when we thought the world was ending, Royal Caribbean cruises fell from $138 to $18 in a matter of weeks. The story was terrifying. Cruise ships were no better than floating Petri dishes. No revenue for years. $15 billion in debt. Possible bankruptcy. As you'd expect, the crowd sold in panic. But if you could strip the emotion and answer the 2 questions above, that stock was one of the greatest bargains of a lifetime. What is Royal Caribbean actually worth if someone bought the entire company today? They owned 26 ships worth roughly $800 million to $1 billion each on the second-hand market, because even in a pandemic, steel and engines have scrap value. Add private islands, cash, trademarks, booking software, and the fact that humans have taken cruises for leisure since 1844 and almost certainly will again once a vaccine exists. A conservative estimate of the private market value would place the Royal Caribbean at about $20 to $25 billion, which leads us to question 2. What was the market valuing it at the bottom? $2.5 billion. You were being offered $25 billion of assets for $2.5 billion because people were scared. That's not investing. That's picking up money in a war zone. The stock went on to 7x in the next 18 months. The people who bought weren't smarter than you. They just refused to let a terrifying story override basic arithmetic, which is why you must learn the 4 lenses of valuation. The 4 lenses of valuation. There are 4 primary ways professional investors answer, "What is this thing worth?" Each lens has killed amateurs who used only one. Earnings power. The price-to-earnings ratio is the first thing retail investors look at, and often the last thing they should trust in isolation. In early 2000, Qualcomm traded at 120 times earnings. Expensive, right? Wrong. They owned patents on CDMA technology that every 3G phone on Earth would soon need. Earnings were about to explode from $200 million to $3 billion in 4 years. The insanely high PE was actually dirt cheap because the E was misleadingly low at that moment in time. Conversely, in 2007, Washington Mutual traded at 8 times earnings, apparently screamingly cheap. Except those earnings were coming from subprime mortgages that were about to vaporize. 8 times 0 is still 0. I know, because I owned it. Here's the lesson. PE only works when earnings are sustainable and reasonably predictable. Ask any banker in 2009 how predictable bank earnings turned out to be. In the Little Book of Value Investing, Christopher Brown boils the PE trap down to one unforgettable sentence. You don't buy a company because it has low earnings today. You buy it because it will have high earnings tomorrow, and the market hasn't noticed yet. Here's how you use that right now. Take any stock you're eyeing. Pull the last 10 years of earnings from Yahoo Finance or your broker. Throw out the freak COVID year if you want. Average the rest. That's your normalized earnings power, the real economic engine, not some temporary sugar high or depression. Now ask 2 dead simple questions. Are these average earnings about to grow a lot because something permanent just changed for the better, like maybe a new drug approval? Or Amazon exiting the Indonesian market? Or the TikTok ban helping Meta? Also, is the current PIE based on today's depressed or inflated number, not the normalized one? If the answer to both is yes, you're looking at the same setup that made Qualcomm in 1999, Apple in 2013, or Meta in 2022, once-in-a-decade bargains hiding behind a high or low PE headline. Do this once and you'll never fall for the PE trap again. Here's the second lens. Asset value. This is Warren Buffett's famous margin of safety when he was younger and poorer. In 1973, Buffett bought the Washington Post for $80 million when the market cap was $100 million. The company owned television stations licensed by the FCC, land, printing presses, and the most prestigious brand in political journalism. Asset value alone was north of $500 million. The market was handing him $500 million of assets for $80 million because advertisers were temporarily scared of Watergate fallout. He made 100x his money over the next decades. When I was broke in 2009, this saved me. I bought Ford Motor at $1.50. Not because I loved cars. I can't change my own oil to save my life. But I bought Ford stock because Ford had $25 billion in cash, and factories, brands, and dealer networks worth far more than the $6 billion market cap. Even if they went bankrupt, which GM and Chrysler did, bondholders and shareholders would still recover several dollars per share in a liquidation. That's why you must take note of this. If a stock trades below 60 to 70% of tangible book value and the business is not permanently impaired, more often than not, you are looking at a bargain. In his classic security analysis, also called The Investor's Old Testament, Benjamin Graham wrote, "The essence of portfolio policy for the enterprising investor is buying companies for less than their intrinsic value, and the best measure of intrinsic value in many cases is what the business would fetch if sold or liquidated today. Net asset value is the ultimate floor. Pull up any stock. Go to the latest balance sheet. Take total assets minus all liabilities, minus all intangible assets, goodwill, patents, brand value, and divide by shares outstanding. That's tangible book value per share. If the stock trades far below that number and the company isn't burning cash to oblivion, you have a hard floor under the price, like Citigroup at $0.30 tangible book in March 2009, which went to 5+ in 2 years. Even if the business stumbles, private equity, a competitor, a liquidator, Someone will eventually pay at least that much to own the assets. Buy with a margin of safety. Probably under 70% of tangible book, and you can literally sleep through bear markets. I did it with banks in 2009 and Ford at $1.50. The math doesn't care about headlines. Now on Lens 3, private market value. What if a rich person walked up to you tomorrow and said, "I want to buy your favorite company outright. No Wall Street games, cash on the barrel." What would they pay? This is how private equity thinks. They use multiples of EBITDA, that's earnings before interest, taxes, depreciation, and amortization. Why? Because those are closer to cash flow. In 2012, Heinz traded at 14x EBITDA. Warren Buffett and 3G Capital bought it for 18x EBITDA, or about $23 billion. The market screamed, overpaid. They stripped $2 billion of costs, sold pieces, and flipped it years later for $50+ billion. The public market was wrong because it was obsessed with short-term earnings. Private buyers look at control cash flow. Retail darling Chipotle crashed 60% in 2018 because of E. coli headlines. It fell to 13x EBITDA. Historically, fast casual restaurants with cult brands trade 20-30x in private deals. But Bill Ackman bought a stake, and the stock tripled. Again, the story was ugly, but the private value was obvious. In Margin of Safety, Seth Klarman wrote, "Ultimately, the price you pay for a security is the most important determinant of your return. A private buyer would never pay more for a business than its conservatively estimated private market value." You can Google comparable company transactions or precedent M&A multiples for any industry your stock is in. For example, fast casual restaurants like Wingstop or Shake Shack have sold privately for 18 to 25x EBITDA in recent years. If Chipotle is trading at 14x EBITDA while the world panics about food safety, a private buyer would snap it up in a heartbeat. You just found a bargain the market is too scared to see. So when the stock price falls far below what a sophisticated buyer would cheerfully write a check for today, you're no longer speculating. You're buying dollars for 50 cents, which is why you must always consider the fourth lens: growth value. This is where most 2021 disasters happened. Growth investors pay high multiples today for earnings that will arrive tomorrow. The math is simple. If a company can grow earnings at 30% per year for a decade and maintain decent margins, a 60x PE today can be mathematically cheap. Sea Limited, Singapore's Amazon, traded at what looked like an insane 15x sales with negative earnings in 2019. But they were growing revenue 200% plus per year in a $100 billion plus Southeast Asia e-commerce market that was 5% penetrated. Fast forward 5 years, revenue is up 10x, they're profitable, and early investors made 20x. The so-called expensive multiple was actually conservative. Compare that to Peloton that traded at 12x sales in 2021 while growing 100%. Looked reasonable, right? Except the growth was 100% because of COVID lockdowns, not because the world suddenly decided stationary bikes were the future. Once gyms reopened, growth went negative. The stock fell 95%. Note this: high multiple on temporary growth is a widowmaker. Here's the acid test for growth stocks. Can this company at least triple revenue in 5 years while expanding margins? If not, you're paying Ferrari prices for a second-hand Honda Civic. In the Little Book of Valuation, Aswath Damodaran boils growth down to one brutally honest sentence: growth is only valuable if it is accompanied by excess returns. If you grow like crazy but earn no more than your cost of capital, you have added zero value. So, before you pay a sky-high multiple for any growth stock, open Excel and ask 2 questions. Can this company realistically triple its revenue in the next 5 to 7 years while keeping or expanding its profit margins? After that growth, will it still earn significantly more on its capital than what investors could get elsewhere? If the honest answer to either is probably not, walk away. No matter how exciting the story. Tesla in 2019 passed both tests. Peloton in 2021 flunked both. One made early buyers 20x. The other destroyed 95% of their money. That single Damodaran filter would have saved millions of people from the 2021-2022 growth stock graveyard. Use it every time. So what are the red flags that scream expensive even when the multiple looks low? Red flags. I learned these the hard way. One is chronic capital intensity that never ends. MoviePass sounded revolutionary. $10 per month for unlimited movies. But guess what? It burned $250 million in cash trying to make it work and went to zero. The multiple didn't matter. The business model was physically impossible. Some businesses are like leaky buckets. No matter how much revenue pours in the top, most of it leaks out the bottom as never-ending capital spending just to stay alive. For instance, airlines will forever buy new planes. Telecoms laying endless fiber. Steel mills replace furnaces every decade. Or chip fabrication plants that cost $20 billion each and become obsolete in 5 years. Even if the stock looks cheap at 8x earnings, you're not buying a cash machine. You're buying a perpetual money incinerator. Southwest Airlines has been a decent investment over decades only because it is the rare exception that squeezes blood from stones. Most capital-intensive companies destroy shareholder value quietly for decades. If the depreciation line is chronically close to or bigger than the capex line, run. Your money will never compound. It will just fund the next treadmill. Next, customer concentration. When I bought BlackBerry in 2012 at 0.5x sales, 70% of revenue still came from corporations that were visibly switching to iPhones. No price is low enough for a melting ice cube. Customer concentration is a silent killer disguised as great partnerships. When one customer accounts for 30 to 40% or more of revenue, the stock may look cheap on paper. But you're not owning a business. You're owning a single phone call. If that big customer walks, renegotiates brutally, or goes bankrupt, your earnings can vanish overnight. In 2011-2012, BlackBerry still traded at 0.5x sales because 70% of revenue came from wireless. Carriers and enterprises visibly fleeing to iPhone and Android. Lumen Technologies looked cheap for years, while Sprint and Verizon, its huge wholesale clients, cut spending. The stock fell 95%. No valuation multiple survives the moment your largest customer decides you're no longer essential. Treat any company with a 30% plus customer as uninvestable unless the price assumes that customer disappears tomorrow. Serial acquirers who destroy value. In 2015, Valent Pharmaceuticals traded at only 15x earnings after years of over 30% growth. All growth came from buying other drug companies and jacking prices. Organic growth was negative. The moment they couldn't acquire anymore, the house of cards collapsed 99%. Also take note of Kao, balance sheet bombs. Enron traded at 40x earnings right until the end. Debt was hidden off balance sheet. Always look at total debt versus operating cash flow. If interest expense eats more than 30 to 40% of operating cash flow, run. Balance sheet bombs are hidden debts or obligations that can wipe you out overnight, even when earnings look fine. Lehman Brothers showed safe leverage ratios while secretly pledging the same collateral 30 times over. Here's the simple rule you can check now. Take total debt, including leases, pensions, and off-balance sheet items, and divide by the past 3 years' average free cash flow. If debt is more than 5 to 6x cash flow, or if annual interest eats over 40% of operating cash flow, the balance sheet is a loaded gun. No PE, no growth story, no visionary CEO can save you when creditors take over. Walk away. Management with a history of lies. Value investing requires calculating a company's intrinsic worth through historical earnings, book value, and private market comparables, then only buying at a 40 to 60% discount while avoiding any management with a history of fraud. Success comes from disciplined mathematical analysis rather than following market narratives. Buying quality assets during panic When prices drastically undershoot fundamental value, the strategy Warren Buffett has used for 70 years. Disclaimer: this video is for educational and informational purposes only and does not constitute financial investment or trading advice. The content is based on opinion and experience, and past performance is not indicative of future results. You should do your own research and consult with a licensed financial advisor before making any financial decisions. No guarantees of income or success are made. Use the information provided at your own discretion and risk. Stay smart out there.